Most people think becoming a millionaire requires a miracle, or a massive salary, or some genius-level stock-picking skill. But here's the uncomfortable truth. The difference between $100,000 and $1 million is not luck. It's not timing, and it's not about finding the next Tesla or Nvidia. It's about one simple timeline. The timeline almost nobody knows, and the timeline that Charlie Munger spent his entire life trying to explain. Munger once said, "Understanding both the power of compound interest and the difficulty of getting it is the heart and soul of a lot of money wisdom." Today, you're going to see, visually, clearly, step by step, exactly how $100,000 becomes $1 million at 6%, 8%, and 10% returns. Not theoretically, not in a perfect world, but in real numbers, with real math, over real years. And here's the twist. The difference between 6% and 10% looks tiny, until you realize it can change your retirement by more than 15 years. By the end of this video, you'll know the exact number of years it takes to turn 100,000 into 1 million, why the first 100,000 feels painfully slow, and why everything after that explodes faster than you think. This is the part no one teaches you in school. No one explains in a 60-second TikTok video, and no banker will ever say out loud. And once you see the math, you'll never look at saving, investing, or retirement planning the same way again. Let's be honest. A lot of Americans, especially between ages 35 and 65, feel behind. You might have a little saved, maybe $50K, maybe $100K. You're working hard. You're contributing to your 401k. But it still feels like you're crawling uphill. And you're thinking, is this even enough? Am I too late to reach $1 million? How long will this actually take? You're not alone. The reality is, retirement is more complicated than ever. Social Security feels less reliable. Inflation is eating savings faster. The average American has less than $90,000 saved for retirement, and market volatility scares people out of long-term consistency. But here's what Charlie Munger understood better than almost anyone. The first rule of compounding is to never interrupt it unnecessarily. Most people don't fail because the market is bad. They fail because they interrupt the compounding timeline that would have made them wealthy. And that's why today's video matters. Because once you understand the actual math, once you can see the timeline with your own eyes, it becomes clear that you're not behind. You're just missing the roadmap. And that roadmap begins at one number, $100,000. Munger called it the hardest but most important money you'll ever make. And once you hit it, everything changes. The math changes. The speed changes. Your wealth trajectory changes. 100K, $1 million, 6%, 8%, 10%. Breakdown coming up. Transition line. But here's what most people get wrong, and why their timeline never accelerates. To understand how 100K becomes $1 million, you need to understand why the journey feels brutally slow at the beginning and breathtakingly fast later on. This is where most investors misunderstand compounding. They expect growth to feel linear, but compounding is exponential, and exponential growth hides its power in the early years. Charlie Munger put it perfectly. The first $100,000 is a bitch, but you gotta do it. Why did he say that? Because the math is stacked against you early on. But once you push through that wall, the math starts working for you. Here's the truth most people never hear. The first 100K might take 10 to 15 years for the average American. But going from 100K to 200K might take only 7 to 8 years. And going from 500K to 1 million, sometimes just 6 to 7 years depending on returns. Why? Because every dollar you saved in the early years was carrying the weight by itself. But every dollar you save later is being lifted by all the previous dollars, which are now generating returns for you. The math goes from you earning money to your money earning money to your money's money earning money. That third stage is where people get rich, and most Americans quit long before they get there. This is where the timeline gets shocking. Let's say you've reached $100,000 today. Here's what happens without adding another dollar. At 6% annual returns, year 1, $106,000. Year 5, $133,800. Year 10, $179,000. Year 30, $574,000. At 8% annual returns, year 1, $108,000. Year 5, $146,900. Year 10, $215,900. Year 30, $1,006,000. At 10% annual returns, year 1, $110,000. Year 5, $161,100. Year 10, $259,300. Year 30, $1,744,000. Pause for a second. Same $100. 3 different timelines. 3 completely different retirements. This is why understanding returns isn't optional. It dictates the entire trajectory of your financial life. I hear this all the time. 6% versus 8%? That's only 2%. Who cares? Here's why that thinking destroys wealth. Over 30 years, that small 2% difference turns $100 at 6%, $574,000. $100 at 8%, $1,006,000. That's a $432,000 difference. Same person, same starting point, different understanding of compounding. Charlie Munger warned about this. Small advantages accumulate to huge consequences. Most people underestimate what small, consistent differences do over long periods. The wealthy don't. Let's recap the foundation before we advance to implementation. $100 is the break-in point where compounding becomes meaningful. Early growth feels slow because exponential curves disguise themselves. The difference between 6%, 8%, and 10% returns can reshape your entire retirement. Most Americans don't fail because they don't earn enough. They fail because they underestimate time. And now that you understand why 100K matters, let's move to something even more important. What do you actually do once you reach it? And how do you accelerate the path from 100K to $1 million intentionally? Now that you understand the foundation, the psychology, the math curve, and why the first 100K is the battle, let's shift into application. Because knowing compounding is powerful, but using compounding is where wealth is built. Charlie Munger said, "Take a simple idea and take it seriously." The simple idea here is compounding, but taking it seriously means knowing exactly how to implement it with real numbers, real timelines, and a real plan you can start tomorrow. Let's look at what actually happens when you invest with consistent returns. Say you start with $100,000 and you continue adding money each year. We'll use a realistic contribution amount, $6,000 per year, roughly $500 per month. Now watch the difference at various returns. At 6% annual returns, year 10, 100K, 246K thousand. Year 20, 100K, 475K thousand. Year 30, 100K, 838K thousand. At 8% annual returns, year 10, 290K thousand. Year 20, 673K thousand. Year 30, 1.19 million. At 10% annual returns, year 10, 341K thousand. Year 20, 950K thousand. Year 30, 1.77 million. This is where most people have their aha moment, because the contributions barely changed, but the outcome changed everything. Why? Because you didn't just rely on 100K compounding. You added new fuel to the fire every month. Let's bring this to real life. Imagine you're 42 years old with 100K in your 401K or IRA, a steady job, and the feeling of being behind. Here's your timeline if you invest $500 a month. At 6% returns, age 52, $246,000. Age 62, $475,000. Age 72, $838,000. At 8% returns, age 52, $290,000. Age 62, $673,000. Age 72, $1.19 million. At 10% returns, age 52, $341,000. Age 62, $950,000. Age 72, $1.77 million. Same person, same job, same contribution, different understanding of compound interest. This is where the wealthy edge comes from. They understand timelines, not just investments. Pause moment. Where could you be in 10, 20, or 30 years if you simply stayed consistent? Now let's talk acceleration, the controllable levers that most Americans ignore. 1. Contribution rate. Even an extra $100 a month can shave years off the journey. Example. At 8% returns, going from $500 a month to $600 a month gets you to $1 million 2 to 3 years sooner. 2. Return rate, understanding asset mix. You don't need high-risk stocks. You simply need to avoid interrupting compounding. Historically, S&P 500, 10%. Balanced index portfolio, 7 to 8%. Knowing this changes everything. 3. Time in the market, not timing. Munger warned repeatedly, the big money is not in the buying or selling, but in the waiting. Most people lose time by panicking during downturns, stopping contributions, trying to wait for the right time, selling after losses. Every interruption stretches your timeline by years. Here are the mistakes that silently destroy compounding for 90% of people. Checking your account daily increases panic, decreases discipline. Trying to achieve 20 to 30% returns leads to gambling, not investing. Switching strategies every year kills compounding's consistency. Oversaving in cash. Cash loses to inflation. Withdrawing early from retirement accounts. Penalties plus loss of compounding. Pause moment. How much wealth have people accidentally destroyed simply by interrupting compounding. Now that you understand how the timeline works and how to actually accelerate the path from $100,000 to $1 million, it's time for something deeper. The part only Munger-level thinkers truly master. The advanced insights that separate average investors from exceptional ones. We've covered the foundation. We've covered the timeline. We've covered the math. Now we're entering the stage that separates the average investor from the exceptional one. Because not everyone who understands compounding becomes wealthy, but everyone who becomes wealthy understands compounding deeply. Charlie Munger had an unusual way of expressing this. Understanding the power of incentives and the power of compound interest can solve most of life's problems. Most people understand compound interest intellectually, but the wealthy understand it philosophically, as a way of thinking, not just a financial formula. The wealthy avoid the one behavior that destroys 30 years of progress: interruptions. Most Americans derail their timeline by stopping contributions for a few years, selling during downturns, pausing investing until things feel safer, waiting for elections, recessions, or better prices. But here's the truth. An uninterrupted 8% for 30 years beats a perfectly timed 12% for 10 years. Munger warned, a lot of success in life comes from knowing what you want to avoid. Avoid interruptions, and the timeline takes care of itself. Most people ask, how do I get higher returns? The wealthy ask, how do I make sure my returns last longer? A 10% return for 5 years is meaningless. A 7 to 8% return for 35 years is life-changing. Let's look at the comparison. 10% returns for 10 years starting at $100 adder. Final amount, $259,000. 8% returns for 30 years starting at $100 dollars. Final amount, $1.006 million. This is why Munger said, the big money is in the waiting. High returns don't build wealth. Durable returns build wealth. Most people think wealth is about picking investments, but the truth? Your behavior is the investment. The market doesn't determine whether you reach $1 million. Your discipline does. If you stay invested, keep contributing, ignore noise, respect the timeline, you win. Think about it. The S&P 500 has averaged around 10% for nearly a century. Most investors don't get anywhere near that. Why? Because they interrupt compounding through emotion. Munger warned, a lot of people with high IQs are terrible investors because they have terrible temperaments. Financial success is temperament, not talent. This is the milestone almost nobody talks about. Most people focus on getting to 100K. But the explosion happens later, at 300K, 400K, 500K. Once you cross 500K, your investments add more per year than your contributions. Your timeline bends upward sharply. $500K to $1 million happens twice as fast as $0 to 100K. This is the stage where wealth becomes inevitable, if you stay on the track. Pause moment. What would your life look like if your money started working harder than you do? This is the final mental shift. Most Americans think, I need results this year. Is my portfolio up or down this month? Should I wait until after the election? The wealthy think, what will this decision look like in 2035? What will this investment mean in 2045? Will this interrupt my 30-year compounding window? Munger said it best. The first rule of compounding is to never interrupt it unnecessarily. This isn't just math, It's a worldview. And it's the worldview that takes 100,000 and turns it into $1 million and beyond. Now that you understand not just the math, but the mindset behind building wealth, it's time to translate everything into action steps you can start using tomorrow morning. The part where the theory becomes a roadmap. We've talked about the math. We've talked about the mindset. We've talked about Munger's wisdom. Now it's time for the part that actually changes your life. What do you do starting tomorrow to stay on the $100,000, $1 million timeline? Because compounding isn't magic. It's a set of behaviors repeated consistently over years, not months. Charlie Munger used to say, "Spend each day trying to be a little wiser than you were when you woke up." Today, that wisdom turns into a step-by-step plan. Most Americans never define the return they're aiming for. If you don't know the target, you won't know the timeline. Here's the simple rule. 6% realistic for conservative or balanced portfolios. 8% typical for long-term index investing. 10% historical S&P 500 average, but requires discipline and patience. Pick the lane that fits your comfort, age, and timeline. Because once you pick your return, the path becomes measurable. You can say, at 8%, I reach $1 million in about X years. At 10%, I get there even faster. This turns compounding from an idea into a roadmap. If you want to stay on the millionaire timeline, remove willpower from the equation. The wealthy automate. 401k contributions, IRA funding, brokerage transfers, monthly index fund purchases. Why? Because automation prevents emotional decision-making. If you automatically invest $500 to $700 a month, you're stacking the odds massively in your favor. This isn't just convenient, it's a compounding accelerator. Munger and Buffett both preached simplicity. Buffett famously said most people should just use a low-cost S&P 500 index fund. You don't need trading, stock picking, crypto predictions, market timing. You need low fees, high discipline, long runway. A simple portfolio makes the timeline reliable. A complicated portfolio interrupts it. Here's where most people fail. Not because they're lazy, not because they're stupid, because they let life interrupt compounding. Your rule is simple. Only add money. Never take money out. Never stop the timeline. During elections, recessions, market crashes, inflation spikes, job changes. You do one thing: stay invested. This is the difference between the person who reaches $1 million and the person who gets stuck at $300K. Over-monitoring destroys discipline. Check your accounts once a year, at tax time, with a long-term mindset. That's it. Munger warned, activity is the enemy of intelligent investing. Your goal is consistency, not busy work. Now that you have the roadmap, the clear steps, the structure, and the discipline the wealthy rely on, let's zoom out. Let's talk about the bigger picture. Why this isn't just about money, and why compounding is actually a philosophy for life. By now, you've seen the math. You've seen the timeline. You've seen the difference between 6%, 8%, and 10%. And you've seen how $100K becomes $1 million. Not by magic, not by luck, but by consistency. But here's the part no chart can show you. Compounding isn't really about money. It's about patience, about temperament, about becoming the kind of person who trusts the long term more than the short term noise. Charlie Munger spent 99 years repeating one message. It's waiting that helps you as an investor, and a lot of people just can't stand to wait. Once you understand the power of waiting, your relationship with money changes. You stop chasing. You stop panicking. You stop trying to time anything. Instead, you build a financial life that compounds quietly, automatically, in the background, while you live your real life in the foreground. Because the truth is, the goal was never $1 million. The goal was freedom, control, peace of mind. 100K is the starting line. Compounding is the engine, but you are the driver. So if you're sitting there thinking, I'm behind, I'm late, I should have started sooner, remember this. The best time to start compounding was 20 years ago. The second best time is today. And as Munger reminded us, the world is full of foolish gamblers, and they will not do as well as the patient investor. Be the patient investor. Be the one who stays the course. Be the one who sees 100K for what it really is. A doorway to a financial future most people will never reach because they quit too early. If this breakdown gave you clarity, if you now understand your timeline better than ever, make sure you subscribe. This channel exists to remove confusion, replace anxiety with knowledge, and give you the tools Charlie Munger wished every American understood. We release deep dive videos every week designed to make you a smarter, calmer, wealthier investor. So hit subscribe, turn on notifications, and join the group of people taking their financial lives seriously. Before you go, I want to hear from you. What return rate are you planning your life around? 6%, 8%, or 10%? And why? Drop your answer in the comments. I read every single one. And if you want to go even deeper, the next video is already waiting. The compounding curve that turns 500K into $2 million faster than you think. It's the perfect follow-up to this one, because it shows what happens after you cross the milestones most people never reach. Click the end screen. I'll see you there.